How does a call-debit spread work? If you are curious about how a call-debit spread functions in options trading, you are in the right spot. Let's break it down step by step. A call-debit spread is a strategy used by investors who think a stock's price will rise within a certain time frame. This involves two main actions: buying a call option at a lower strike price and selling a call option at a higher strike price. Both options share the same expiration date and are of the same type, which in this case are call options. First, let's talk about the long call option. This is the option you purchase, giving you the right to buy the underlying stock at the lower strike price. Typically, this option has a higher premium because it is more likely to be profitable. On the other hand, the short call option is the one you sell. This obligates you to sell the underlying stock at the higher strike price if the buyer decides to exercise the option. The premium you receive from selling this option helps reduce the overall cost of buying the long call option. Now, how does this all come together? The cost to set up the spread is calculated as the premium paid for the long call option minus the premium received from the short call option. This results in a net debit to your account. When it comes to profit potential, the maximum profit is capped. You can calculate it as the difference between the two strike prices minus the net premium paid. For example, if you buy a call option with a strike price of $50 and sell a call option with a strike price of $55, and your net cost is $3, your maximum profit would be $2. This is because you take the $5 difference between the strike prices and subtract the $3 cost. On the flip side, the maximum loss is limited to the net premium paid. If the stock price stays below the lower strike price at expiration, both options will expire worthless, and you will lose the net premium you paid. The break-even point is another important aspect. It is calculated as the lower strike price plus the net premium paid. In our earlier example, if you bought the $50 call and sold the $55 call with a net cost of $3, your break-even point would be $53. Call debit spreads are particularly useful when you are optimistic about a stock but want to manage your costs. By selling a higher strike call, you lower the overall cost of the trade but also limit your potential profit. This strategy works well in low implied volatility environments, as it helps keep options premiums manageable. When considering this strategy, think about the balance between risk and reward. While it caps potential profits, it also reduces the initial cost. Lower volatility can make this strategy more appealing due to lower premium costs. Timing is also key. This strategy is best used when you expect a stock to rise within a specific time frame, ideally before the options expire. In essence, a call debit spread is a practical strategy for traders who are bullish on a stock but want to keep their costs in check. It offers a balanced approach to managing risk and potential profits in options trading.